Welcome everybody. Thank you everybody for showing up tonight for this incredible seminar, timely seminar on the effects of the rising interest rates in Canada and how they affect you with home ownership. I've got some distinguished guests coming to join us this evening to talk about lending, financial planning, legal implications of these rising interest rates. And without further ado, I'd like to introduce you to Gretchen Casey from Pineapple, and she's a lender. We'll be talking to you about how we might be able to reduce our payments or whatever. Let's see what Gretchen has to say.
All right, thanks so much, Stu. Very happy to be here today to talk about what we can control. We can't control the rates, but we can control some actions, how we respond to the rates. And I'm really grateful to have the opportunity to be here. Thanks, Stu and the team for having me here. I've been serving Durham region for 19 years as a mortgage agent. I'm with Pineapple Mortgages, and I love supplying solutions to homeowners, home buyers, as well as investors who are buying rental properties. So why are the rates where they're at? Well, inflation has a lot to do with the rates. So the Bank of Canada sets the overnight rate, which has to do with the variable. So when the Bank of Canada decides to increase the overnight rate, then the prime rate goes up, and anyone who has a variable rate mortgage is now going to have a higher interest rate. And if the Bank of Canada lowers the overnight rate, then the variable rate will go down. Depending on your lender, you may have a set payment that will only go up at a certain point at what's called the trigger rate, or you may have your payment go up and down with prime and feel that effect of the dramatic increases that have happened, especially over like the last year. So you can see on the first chart, inflation has gone up. It's back down quite a bit from the high, but it's still not where the government wants it to be. So they use the prime rate as a way to try to force inflation down. Unfortunately, it doesn't always work, and if you take mortgage rates out of the equation, inflation is actually below 3% already, which is their target. So that's on that side is variable rate. The fixed rates are based on the 5-year bond yield. So mortgagedashboard.ca is a great site where you can see the bond yield. So if the bond yield's going up, the fixed rates are going to increase, and if it goes down, that means hopefully the banks honor that decrease and offer you a decrease. So if you're about to make a decision, that's really helpful if you're going to go into the fixed rates to see where is it headed. So the mortgage rates, as we can see right now, are much higher than they have been over the last year. The average rates now are between 5 and 6%, whether you are fixed or variable. People back a few years ago were getting rates of 1.89 on the fixed rate. So that means if you're up for renewal, it's like you're going from a payment and a rate based on 1.89, now you're going to be based on 5%. It's a huge increase, it's a huge change, and that's why a lot of people are nervous, because they are going to have these situations to deal with where they, again, have no control of what the payment's going to be. There's a little bit of things, there are some things that maybe can be controlled, so we'll talk about those. And as you see, the payments, of course, go up as soon as rates go up, especially if you're in a variable rate mortgage. The thing about the variable is a lot of investors like the variable rate, because if you break a variable rate mortgage and decide to sell a property, your penalty is 3 months interest. It's not more than that. Whereas if you're in a fixed rate and you decide to break it, you're going to have a minimum of 3 months interest, or what's called interest rate differential, which is basically all the money the bank's losing because you broke that mortgage, you're going to have to pay them. And I personally decided to break a mortgage, and it cost me $10,000 to do that, but it was because I wanted a lower rate, and it over time made sense. But that's why investors typically wanted that variable, but now even investors are like, it's just too high, we're going to lock in and hope to have a little bit of a better payment and have cash flow, that they haven't really been getting the cash flow that they want. So tools and tips to help people for renewing, buying different different scenarios, refinancing. So this is an example of a couple, Tim and Terry. They're up for renewal and they aren't really sure what they want to do. They're kind of been in a comfort zone with a low rate, a low payment, and now it feels really uncomfortable to have this go up. So they don't really know what their options are. Income has been a challenge because the wife, she was staying home when her kids are older now, but she was staying home, so they didn't have her income. They really didn't know what to do, and they didn't have a plan. So a big part of it is knowing, okay, the big question is what's going to happen with rates? When are they coming down? And that everybody wishes we had a crystal ball, we don't. But based on BMO, TD, Wawa.ca, which I'm not totally sure who they are, but they are always talking about what's going to happen. And for the most part, the expectation is that if you're in the variable, the prime might go up one more time this year before December, or the end of the year. Might go up 0.25, maybe it'll stay the same, and then we'll start to see the lower prime rate next year, and same with the fixed rates, that the fixed rates will start to come down as well. So basically, anywhere from 2 to 4 year term is probably the best, because if you get the 5 year and you're like, oh, I left in at 5.5 or 6%, and 2-3 years from now it's down to 4%, you're kicking yourself. So most people are going for those shorter terms now, and it does make sense. I can't, again, still promise them that's how it's going to happen, but at the moment, depending on, COVID or whatever else might happen in the world, definitely those are the forecasts. So for this couple, again, consider a shorter year term. What I love to do is somebody calls me, they're like, I'm up for renewal, I'm with TD, what do you suggest? And I always say, okay, well, let's figure out the term. So let's say you want a 2 or 3 year. This is the best 2 or 3 year in the market. I'll tell them what it is. I'll say, go back to your lender, TD, tell them you want this rate. Ask them if they'll extend your amortization. Normally on a renewal, they won't. But if you're in a bind and you really can't afford the payment, they might do 30 year, and sometimes lenders are doing even longer than 30 year to help clients get through a tough period. So they might, have a need to extend. And then, basically I want to give people leverage. I don't want to make them switch if they don't have to. But then if that lender is like, no, I'm stuck at 5.89 and everybody else, maybe we can get them 5.25 somewhere else, then it's probably worth the effort to make the switch. And the effort just means you're giving me documents, they've got to go to the lender might want an appraisal, but the client doesn't pay for that. So it's just their time is really what it will cost to make that switch to a different lender if the lender isn't competitive. And what else can they do? At that time of renewal, consolidating debt might make sense. It depends on your interest rate and your payments. So at that point, it becomes a refinance, not just a renewal. The difference being is that your rate's going to be a little bit better for just a straight switch over and no legal fee, no appraisal fee, versus refinance. Now your rate's a little bit more, you are going to pay the legal fee, you are going to pay the appraisal fee. So it's a different transaction. But again, it might still make sense to do it now, consolidate debt. If you've got, I have clients, $150,000 credit card debt or other debt, that maybe it's time to bring those debts added to the mortgage at a lower rate, lower payment, and not have that stress of that high payment. I also do ask too, like if you've got a car payment, well maybe you have a 0 interest car payment. So maybe your payment's a little bit high, but you're not paying interest on it. So it's a matter of looking through what the debts are to make sure what makes the most sense based on the situation. And again, in this situation, there was options of could she return to work to help because the kids were now older. Could he get a raise at work? Sometimes people aren't comfortable with that idea, but in truth, maybe they deserve it and they can present the case of, hey, I add value and maybe it's time for the raise. A second job, or hire a money coach. And I know some good money coaches that, yes, they cost money. However, if they're going to save you money or help you find lost money, hold your hand through maybe a budgeting scenario. Someone don't like the word budget. Nobody likes the word budget because it's like, I don't want to stop going to Starbucks every day and having someone tell me I can't buy new clothes. But can use different terminology where you realize it's really a short-term pain for long-term gain. And it might only be short-term because, again, the rates are coming down, inflation's coming down, maybe our food costs are falling down, our car prices, so it's hopefully not forever. So they're happy now because they've got that figured out. What this couple ended up doing was they did just do a, sorry, let me just make sure, how do I go back over here? The left. Okay, we'll just see. Anyway, they did end up renewing and doing a 3-year term, and also at the same time were qualified to add a line of credit. And a lot of people at renewal time, if they can consolidate debt, but also could add a line of credit. And a lot of people are interested in that because they like to have a line of credit for emergencies, or maybe they're going to buy a rental property down the line. They want to have a line of credit to put the down payment. So at renewal is a good time to add the line of credit if you qualify for it. And so they also were interested in doing private lending. So if you have a line of credit, you can borrow from your line of credit, lend it out to someone else for a second mortgage. And yes, the rates right now are 7-ish%, but on a second mortgage, you can make 16%. So you're making money. It's a way to increase your income by having a line of credit and lending it out. And there's a lot of people wanting private mortgages right now, so there's definitely a market for it. And you can, like mortgage agents can help people lend out money privately, or that people can network with other people and just lend it directly through a self-directed RSP. So they can lend cash, or they can lend an put it in a sheltered RSP as well. So in this case, they have a longer amortization, they have a lower payment, and their plan is actually their son, who they're going to buy together. So they've decided they do want to both downsize, well, not exactly downsize, but sell the homes they have now. Jason is separated and going to be divorced, and he doesn't need the home he's in now, and so they're going to buy together and reduce their costs. And that's happening a lot now, where people are buying multi-generational, buying with friends, anything they can do. And I'm sure you run into that with agreements, doing cohabitation agreements, so that they're protected if anything changes. But that's of course going to become more and more popular when people can't afford to buy in Durham or close to Toronto, in order to just have affordability, as well as I've heard about tiny home communities and other ideas that appeal to people that allow them to have lower living costs. I don't know if you guys hear about garden suites being added in the back of properties, or laneway suites in Toronto. Another way for people to have lower cost of living, and investors to make money off of their bigger lots. So lots of different interesting things are happening. And in this case, with the mortgage, they can port that mortgage when they do sell to another property, meaning you move it over to another property without a penalty, and you keep your interest rate. Ideally, it's good if you have a low interest rate, but again, no penalty. So they're happy. And then we have another family. So they wanted to be real estate investors. Their concern was coming up with the down payment to buy a rental property. Would they be able to do that? And we're just stressed about the whole thing of, oh my gosh, how do you become a real estate investor? It seems overwhelming. What if I have a bad tenant? All of those sorts of concerns, and didn't really know what steps to take and what plans would allow them to do that. So basically, when you have equity in your home, you can refinance up to 80% of the current value. So in their case, when they bought the home, when it was a lower price, and they have a smallish mortgage, and now they can increase that mortgage in order to have the money for the down payment. So they're able to refinance, add a line of credit, and have funds available. And instead of buying another property, they decided instead to renovate their current property, to add a legal basement suite, and then they had the space, they weren't using it, and then they can have that rental income. And a lot of people are doing, converting their current home into multi-unit properties, or as investors buying a single family, converting it into a duplex, triplex. Again, because of the cash flow issue, because And investors do a lot more doing multifamily, like 5-plex, 6-plex, and plus, because again, high interest rates means not as good cash flow, but when you have multi-units, the cash flow is much better. So that's become quite popular. And they're happy. And one more person, so Gertie, single woman and wants to own a home. She was declined at the bank, she had credit issues and wasn't really disciplined in what she was doing. It was just quite busy with her work and her social life, and but she had a good down payment. She managed to save some, and so what we needed to do is do some budgeting, so using a spreadsheet, talking about ways to save money. Simple things like put it on your calendar twice a month to pay your bills, and because she wasn't paying her bills on time, so that's why her credit wasn't good. It wasn't that she didn't have the money, she just wasn't realizing how impactful it is to have bad credit, because you go to a bank and they say your credit score is, 600. That might sound okay, well, it's not. They don't like it. They want it to be as close to 680 and above in order to approve you, and especially if you're refinancing, like 650 is kind of the number. So it's really important for people to keep track of what's happening with their credit and paying on time. She did take some time to get her credit cleaned up. It can take 6 months to a year. It doesn't just jump up automatically just because you made a couple payments on time. So during that time, she was able to save, but prices did go up. So she did actually have the good fortune of having a grandmother who gifted her some funds to help her towards her down payment. We also were able to use contract rate qualifying, and what that means is that if you get an insured mortgage or a bank mortgage, you have to qualify at the actual rate you're given. So let's say it's 5.5%, 6%, plus 2%. So you're qualifying at 8%, or excuse me, well, we're at 6, yeah, 6 plus 2 is 8. So you have to qualify as if your rate is 8%. So that's the stress test. We talk about that. Well, it's hard to qualify at 8%, especially if you're a single person with one income. Maybe you have a car payment. It's difficult, and with the high prices. So there are lenders that will do contract rate qualifying, which means it's no stress test. So you're not qualifying at the rate plus 2. The rate's a little bit more, and in some cases you pay a 1% fee for that. The one important thing is you do have to have 20% down. That's not insurable, so you can't do it if you don't have 20% down. But it really makes a difference on qualifying. So that was the product that we used. And also she did make a decision. Initially she wanted to be closer to like Scarborough, which prices were high, so she decided to actually buy in Curtis because she could work remotely. She didn't have to be in Pickering or Toronto, and she could afford it. So a lot of compromises on her part, but in the long run, she's got what she wanted and happy that that's what could work out for her. So I hope some of this resonated. I'd love to chat with anybody that wants to connect. And I love telling people their options, helping them save, not paying unnecessary interest, and just knowing what's out there and not making the banks rich for no reason. And people just need to be willing to take action. And that's all I have.
Fixed mortgage, the penalty that you have to pay, is it sometimes covered by the next lender? Will they do that
No.
sometimes or no?
No, that's kind of a fallacy. People think that or hope that. They may try to give you maybe a cash rebate or try to give you the best rate they can, but it's not normally done that they would just say, yeah, fine, we'll just swallow that, because they know they don't really have to. They'll get the business somewhere else.
Was it added onto the new mortgage, or did you have to pay it up front?
You could potentially add it on the new mortgage if you qualify to do that, like a bigger mortgage. So in most cases, people don't just come pay it out of pocket. They do put it on the new mortgage. Yes?
If you're able to, and I realize that it's a sliding scale almost on a daily basis, but what would the difference in the rate be on a 1-year fixed versus a 5-year fixed? On a percentage basis, but also, if you can, on $100,000 worth of mortgage. Is that a fair question?
I'll have to double check the actual amount, because I don't remember off the top of my head the dollar amount, but right now, like a 5-year, if it's, again, it depends how much you get, if it's insured, et cetera, but you could be under 6%, high fives, so 5.89, for example. You're gonna be, now 1 years are like 7%. You're going to be in the higher, quite a bit higher. So it doesn't matter as much if you have a small mortgage, but if you've got a, a lot of people now, $800,000 mortgages, $900,000 mortgages, it makes a huge difference. So that's why. So the 3 years is kind of that in-between point where people are like, I am getting a better rate, and I do think in 3 years it'll be better. So that's usually the comfort zone.
And the current rate on on a variable rate mortgage, ballpark?
Anywhere from prime -1, so prime right now 7.2, so like 6.2%. However, if you're getting a rental property, for example, I was just looking at rates today for a client, and most of them are over like prime -0.25. Scotia's at prime plus 0.25, so not great, which is why it's warm, but some people are still like, yeah, but prime's gonna come down. So I think I still want that prime, and again, they're investors and they're wanting that low penalty if they break it. Yes.
A follow-up question?
Yeah.
In the as the interest rates have been climbing, and my variable rate loan has been climbing, is more of the money that I'm paying now going just directly to the interest instead of paying the interest and the principal? And can you clarify that for me?
The higher the rate, the less balanced it is, so more is going towards interest rather than towards your principal, which you want it to go towards principal because you want to pay down your principal because the interest is calculated based on the principal balance. But yeah, it's going to be higher. So if you're, when you were at 1.8, well, when you were lower, you're maybe going to have 40% of it going towards interest, where now you're maybe going to have 65.
Would you, in your opinion, is it a good time to buy? Is it a good time to sell? What is your feeling on the current market?
It depends on your situation, but in general, I feel like if now you can buy, it's not a bad idea to buy because if it's right for you and your lifestyle. Like I mentioned, I moved at the worst time possible, February a year and a bit ago. And the reason I did is because where I lived was very noisy, and there was a high-rise being built next to me, lots of things going on. My husband had developed tinnitus. It was all about quiet. And it was to the point, like, we had to move. It was so difficult for him. So I know it wasn't on paper the right time to move, and I also didn't want to rent because I was like, I don't know where this market's going. Yeah, renting might be brilliant, or it might be the worst thing I ever did. So I bought at what most people would say, why did you buy then? So I think that when you can, and it depends on your situation and your other options, I think real estate, it's a great investment. And yes, maybe now you're not going to make what you would, but if you're going to buy and hold, you're not going to flip it, then in the long run, you're going to, I don't have any statistics about it. You guys, some of the realtors in the room might know, but it's a brilliant investment to have real estate. So that's my opinion.
Excellent. There's an expression that we sometimes hear about you marry your house and you date the mortgage. Is that the right expression? Do you know? Where the house is a long-term relationship where the mortgage can be renegotiated after a 1-year fixed term or after a 3-year fixed term to try to take advantage of better rates then, but you get a depreciated value of a home today because the interest rates are higher.
Yeah.
Does that make sense?
It totally makes sense. And then another thing I would say too, I've had clients where they choose to stay, like if they're young adults, choose to stay living with parents because they have that option, and they buy.
Not in my house, they don't.
Not your house, but they buy a rental property. So it might be in Thunder Bay, it might be in New Brunswick. A lot of people buying out of province, Alberta, which is great, and they wait till they get some buildup of that revenue with the cash flow. And then they buy their property they're gonna live in closer to home. And that's gonna be a constraint. They might even Airbnb the property and make a lot of cash, again, to buy their owner occupied later, but they're still getting into real estate.
I'm throwing a softball at you here.
Correct?
All right, you ready for it?
I don't know.
Would you recommend that I go directly to a bank to ask about mortgages, or what's the benefit of using a broker? Thanks for coming.
Go to a bank, go to, shop around, right? Go to a bank and go to a broker and see what you're comfortable with.
But what's the strength of a broker? What's your USP?
Well, I know products from many, many lenders. Like I know, okay, if I go to Desjardins, I'm gonna get this, and this is why this is right. But for this client, self-employed, bank statement income. So I don't just have a very small box of products available, as well as rates. So and if you're working with someone who's experienced, they're gonna know a lot about what's out there and what's the best thing for someone, as well as having best rates. It's not just about best rates, but that is also part of the package. You know, availability at a bank, you might have 15 minutes with that person because they have a tight schedule. But if you need to talk to me for an hour and a half, we're going to talk for an hour and a half. I'm not going to rush you out. I don't have a quota except whatever I put on myself. So I don't have the pressure, like I have to sell you a product even if you don't want it or it's not the right thing. Schedule, I mean, I generally, I work till 8 p.m. Tuesday, Thursdays, and I work Saturday mornings, so a lot of flexibility there. A lot of Zoom meetings. I don't know if branches are doing Zoom meetings or not, but most of my meetings are, well, it's Google Meet or Zoom, and people are quite comfortable with that, and it's also faster. They don't want to drive to your office and then chit chat for 20 minutes to feel like you're being polite, and it's just quicker and more efficient. Documents are received online through a portal, secure portal. What else? What's that?
Access to private money?
Thank you for helping me here. Yes, access to private money, absolutely, because there's the full range with the broker. You're dealing with banks, credit unions, trust companies, mortgage investment companies, private lenders. There's like this whole range, and being able to fit the client. Like if you come to me and I go, I can tell you, okay, you're not going to qualify at the bank. This is why that maybe we're going to move towards the bank next year, but you know, you don't have to then go to someone else and then someone else. You're kind of, I can tell you where you're going to fit and why, and try to keep you, of course, as cheap as possible. That's always the goal, not to put someone into something expensive, but yeah, I think that's most of it. Anybody else want to tell me?
Anybody else have any questions? I've got one question that we'll edit out. Sorry, do you have a question?
Oh, I did want to say one more thing. But,
Yeah, go ahead.
No, it was just something that Lena and I were talking about. If people are in trouble, because I know that's part of the topic tonight, if somebody's in trouble and they, you know, maybe they're for renewal or maybe they just can't pay the bills because of the cost of living. Right now, there are a lot, well, there's a certain segment of people who are doing second mortgages for with no payments or partial payment. So it's like a 1 year, it's a Band-Aid solution just to help people get through this time with the goal of having an exit strategy. So the exit strategy might be in a year, you're now going to merge this mortgage with your first mortgage that's coming up for renewal in a year. Or you're going to get an inheritance. Or you're going to downsize and move in with a smaller house or buy with your family. So it's not the right for everybody, but it is for someone who's trying to keep their house and doesn't want to lose their house. And doesn't feel comfortable maybe doing a proposal or bankruptcy at this point, and they have equity and they have options. That's the key. They need some equity in their house. They can't be like mortgage rate to the max, but so that is something that's popular, more so than before right now.
Very good. Anybody have any other questions? Excellent.
Good questions.
Well, thank you again, Gretchen. I appreciate your time.